Retail real estate sounds simple until it isn't. I've seen first-time investors make the same painful mistakes over and over again, not because they're reckless, but because no one warned them. If you're just getting started in the retail game, this video is your reality check and your playbook. Today, I'll walk you through the 12 most common mistakes I see beginners make and how you can sidestep them with clarity, discipline, and a little bit of insider insight. Mistake number one, avoiding retail because it feels risky. A lot of first-time investors steer clear of retail altogether. It feels risky, like it's yesterday's asset class. But that's a myth. Right now, retail is one of the most attractive plays in the market. Positive leverage, below replacement cost assets, and real cash flow. That's opportunity. Especially in an inflationary environment, retail's a strategic hedge, not something to run from. Mistake number two, putting all your capital in one deal. If you've got $500,000 to invest, don't put it all into one property. Instead, diversify across multiple assets or join a fund. That way, if one deal underperforms, others can carry the weight. This is about risk mitigation and increasing your odds to long-term success. Mistake number three, thinking this is a get-rich-quick game. Retail real estate isn't a flip. This is a cash flow game. It plays out over 5 to 6 years. You can absolutely see double-digit internal rate of returns from 12 to 18%, depending on the asset, but it takes time, planning, and discipline. Mistake number four, jumping into redevelopment too soon. Redevelopment is sexy, it's exciting, but it's also risky. You've got construction risk, interest rate risk, absorption risk, timeline risk. If you're a first-time investor, stick with stabilized, income-producing assets until you really understand the game. Mistake number five, chasing hot markets without understanding the downside. Hot markets are flashy, but they're also expensive. We prefer quiet markets with stable growth and essential economic drivers. You don't want to buy at the top and hope for appreciation. You want to buy smart and grow from a solid foundation. Mistake number six, over-focusing on the cap rate. Cap rate's important, but it's not everything. Ask yourself, can NOI grow? Will income stay steady? Are you leaving enough working capital for improvements? Context matters. A high cap rate doesn't mean it's a good deal. Mistake number seven, falling in love with the deal. This one's emotional. You find a property, it looks perfect on paper, and suddenly you're too invested to walk away, even when the numbers don't add up. Don't let your emotions write the check. If it stops making sense, walk away. Mistake number eight, letting confirmation bias take over. We all want to be right, but in this business, that can be dangerous. You've got to stay brutally honest in your underwriting. Talk to tenants, talk to business leaders, challenge your assumptions. See the deal for what it is, not what you want it to be. Mistake number nine, ignoring tenant mix and leasing complexity. Real estate is more than just dirt and buildings. It's about who's inside, tenant synergy, co-tenancy clauses, lease expirations. All of that matters. The right anchors drive traffic. The wrong mix can sink the center. Mistake number 10, underestimating operational costs and CapEx. Roofs, HVAC, landscaping, parking lots, it all adds up. If you don't budget for it early, you'll feel it later. Good property management and realistic CapEx planning are non-negotiable. Mistake number 11, not understanding co-tenancy clauses. If a big anchor leaves, it can trigger rent reductions for other tenants. That's a ripple effect that can crush your income if you're not prepared. Always understand your lease obligations before you buy. Mistake number 12, skipping due diligence. Skipping DD is what we call it. This one's simple. Don't cut corners. At RockStep, we've built systems and guardrails because we've made those mistakes in the past. We've overpaid, we've misjudged markets, but we've learned, and we don't do that anymore. You don't have to learn those lessons the hard way. If you're new to retail investing, my best advice is this: be a student. Do your homework. Ask good questions. Lean on people who've done this before. The more you learn, the fewer mistakes you'll make, and the better position you'll be to succeed in this business. And if you want to keep learning, stick with us here. Visit our Learning Center on our website, rockstep.com, and subscribe to our channel. We're sharing everything we know so you don't have to figure it out the hard way.